In this presentation, we share a process using a limited amount of information to gauge your taxes and go through options you have in mitigating your tax bill before year's end. The information contained here has been prepared by Civitas Strategies on behalf of the New Mexico Early Childhood Education and Care Department, West, and Growing Up New Mexico, and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute, an attorney, client, or any other advisory relationship. Reproduction of this information is expressly prohibited. Only non-commercial uses of this work are permitted. In today's conversation, we will discuss how to get started, what information you will need to gather and review, and strategies for mitigating your taxes now. Many business owners do a tax check-in, usually between August and October. Despite the fact that this is actually late summer into early fall, you will often see this referred to as a mid-year tax review. This effort can be an important one since it allows you to see where your tax liability is heading before the close of the year, when many opportunities to affect your tax liability end. Additionally, conducting a review can help you to understand your tax liability since you are required by law to pay at least 90% of your actual taxes for the current year or 100% of last year's taxes to avoid a penalty. A tax review before the end of the year can help you plan how much more you need to pay in estimated taxes to avoid paying even more in penalties. The review involves checking your revenue, the amount you took in so far, and expenses this year against last year's, as well as the resulting profit, that is, revenue less your expenses. You also want to check how much you have paid in taxes so far. This process can be as in-depth as you choose, from just seeing if you are making more money to essentially preparing your own taxes. Before you start your tax review, there are 2 activities you should undertake. First, you should review your previous year's taxes. This will provide ideas for deductions and other strategies you can use this year. If you are a sole proprietor, the easiest way to assess your taxes is using the simple, free online app from the Wisconsin Early Childhood Association and Civitas Strategies. You can access it in English and Spanish. Second, you will want to collect information on your revenue, expenses, and estimated tax payments. Specifically, you will want revenue. All the revenue to date from any sources, subsidies, family payments, the child care and adult care food program, and more. This should include payments made in any form, including cash, checks, cash apps such as Venmo or Cash App. Include not only the revenue you have now, but also what you think you will receive by the end of the year. Expenses. All your expenses to date for your businesses, including payroll, rent, mortgage interest, utilities, supplies, and more. Home-based providers should use their time-space calculation whenever applicable. Estimated taxes. If you are a sole proprietor, you are likely paying estimated taxes quarterly. If you have an S corporation or LLC taxed as an S corporation, your salary is W-2 income and should have tax withholding included in your payroll. However, your profit, the amount you pay yourself above your W-2 income, will require estimated taxes. We'll share more on how you can determine if you are on track later in this tool, but for now, know that you can find your estimated taxes on the U.S. Internal Revenue Service website. If you have a bookkeeping system such as QuickBooks or FreshBooks, likely you can get much of the information from a profit and loss report. If you don't, no worries. You can review your bank accounts, credit cards, and other payment methods to collect the information. Now that you have your information ready, there are 2 approaches to estimating your burden. One based just on your profit, and the other using a calculator based on your overall family income and characteristics. We will run through both options. Of the two options, doing a review just based on profit is the fastest, but it is also less accurate than basing it on your family income. You can likely run through this option in about 15 to 20 minutes. Step 1. Determine your profit. Subtract your total expenses from your total revenue. Remember, this should include your actual and estimated amounts through the end of the year. The resulting number is your profit. For example, if Tonia's information showed $105,000 in revenue and $67,000 in expenses, her profit would be $38,000. $105,000 in revenue minus $67,000 in expenses equals $38,000 in profit. Step 2. Determine your estimated tax. When sole proprietors have a profit, they are required to pay both self-employment tax and income tax. If you are an S corporation owner or an LLC that is treated as an S corporation, your W-2 income is an expense, so your profit is taxed as regular income. That is, there's no self-employment tax. A good estimate for how much of your profit will be taxed is using a rate of 20% if you don't have a state income tax, or 25% if you do. Consider the following example. Tonia had $38,000 in profit, and she lives in a state without income tax. In her case, she would want to estimate her profit using a rate of 20%. $38,000 of profit times 0.20 estimated tax rate equals $7,600 in estimated taxes. Using this rate, Tonia can assume $7,600 in estimated taxes by the end of the year. Next, Tonia can compare this amount against what she has already paid. Tonia had checked with the IRS site when she collected her data and saw that she had paid $6,000 in estimated taxes earlier in the year. $7,600 total estimated taxes minus $6,000 taxes paid to date equals $1,600 in estimated taxes remaining. Based on this information, Tonia should pay another $1,600 before December 31st. In this case, Tonia had a positive number for her profit. But let's say she didn't and found that she will lose money by the end of the year. In this case, Tonia's estimated tax would be 0. She will also want to look closely at her revenue and expenses to see if there's any way to cut costs or boost revenue. Step 3. Mitigate taxes. Before you write a check for additional estimated taxes, you will want to look at the section below on strategies for mitigating your taxes. As you use them, you could then adjust your numbers to better know what you should pay before the end of the year. Back to Tonia. Let's say she decided to put $5,000 of her profit into an SEP IRA, a business retirement account where you can deduct the cost from your business expenses. Tonia's revenue is still estimated to be $105,000, but her expenses have now gone up to $72,000, the original $67,000 plus the additional $5,000 for her SEP IRA. $105,000 in revenue minus $72,000 in expenses equals $33,000 in profit. Since her profit is less, her estimated taxes will be less too. $33,000 in profit times 0.20 20% estimated tax rate equals $6,600 in estimated taxes. Since she has already paid $6,000 in estimated taxes in this scenario, Tonia now only needs to pay $600 more by the end of the year. Now, let's say Tonia wants a more accurate number of her estimated tax bill. In this case, she can use a family income-driven approach. Though she will need some more data to use this method, she will also end up with a more precise number for her taxes based on household income and deductions. Step 1. Gather additional data. In addition to the information you have already collected, to use this approach, you will also want to have any W-2 income information for you and your spouse, specifically your total annual pay and how much withholding has been taken out. You can do this by looking at your latest paycheck to see the year-to-date amounts. If you divide them by the number of months to date to get an average monthly amount, and then multiply that by 12 months to get an annual amount. Tonia's spouse's paycheck showed through the end of June she had earned $54,000 and had $12,000 in withheld taxes. In this case, we divide both numbers by 6, since it's the end of June, to get a monthly average of $9,000 for wages and $2,000 for withholding. We can then multiply the monthly averages by 12 to get an annual average. Monthly wages, $54,000 wages through June, divided by 6 months equals $9,000 of wages per month. Monthly withheld taxes, $12,000 of taxes through June, divided by 6 months equals $2,000 of withholding per month. Annual wages, $9,000 times 12 months equals $108,000. Annual withheld taxes, $2,000 times 12 months equals $24,000. Additionally, you'll want to have information on your children's ages and educational status, your mortgage interest for the year, and your property taxes. Step 2. Calculate your estimated taxes. Calculating your estimated taxes using the family's income and characteristics can be very time-consuming by hand. However, there are many free online calculators you can use. You can find the links to these in the guide that accompanies this video. Tonya entered her information and included her spouse's income, hers, and information on their 2 children. The results showed that when her deductions are included for her whole family, Tonya doesn't need to make any other tax payments since the total taxes due for her family, $15,886, is less than the withholding for her spouse, $24,000. Step 3. Mitigate taxes. In the example in step 2, Tonya didn't need to pay any additional taxes, but if she did, or even if she wanted to just save more, she still has time to mitigate her tax bill. In the next section, we'll share how. Step 2. Calculate your estimated taxes. Calculating your estimated taxes using the family's income and characteristics can be very time-consuming by hand. However, there are many free online calculators you can use. You can find the links to these in the guide that accompanies this video. Tonya entered her information and included her spouse's income, hers, and information on their 2 children. The results show that when her deductions are included for her whole family, Tonya doesn't need to make any other tax payments since the total taxes due for her family, $15,886, is less than the withholding for her spouse, $24,000. Step 3. Mitigate taxes. In the example in step 2, Tonya didn't need to pay additional taxes, but if she did, or even if she wanted to just save more, she still has time to mitigate her tax bill. In the next section, we'll share how. Knowing how much you will owe is only part of the exercise. You also want to identify how you can reduce your tax bill while you still have time. Here are the most common strategies used by child care providers. Contribute to a retirement plan. If you don't already have a retirement plan for your business, setting up one could provide tax advantages. Contributions made to a retirement plan on behalf of the business owner and employees are typically tax deductible. Maximize your home business deduction. If you are a family care business, one of the greatest deductions you can get is for the business use of your home. You will want to make sure you are recording your time accurately and capturing expenses by exclusive or regular use. Maximize your home business deduction. If you are a center business owner and it is appropriate, you may want to deduct home office costs. Look for other deductions. It can be worth the effort to review the things you need for this year and next. Are there items you can stock up on now? Maybe a play structure you have wanted to replace for years? Is there anything you are renting or leasing that you may want to just buy? To be clear, you will want to make sure you are not spending frivolously. If you can make a purchase this year that will save you money, that's great. But buying something you don't need is not a good use of your money. Pay down debt. If your business has any debts, this could be a good opportunity to pay them down. This could save you money in the long run by reducing interest payments. Create a reserve fund. Having a financial cushion can be beneficial for any business. If you have higher profits and steady expenses, consider setting aside some of these profits in a reserve fund to cover future expenses or unexpected costs. Invest in business expansion. With higher profits, you might consider investing in the growth of your business. This could involve hiring more staff, expanding your physical premises, launching new products or services, or investing in marketing and advertising. These investments could potentially lead to an even higher revenue in the future. Defer income. If it's possible, you might consider deferring some income to the next tax year. This could involve, for instance, delaying the billing until the beginning of the next year. However, this strategy should be used carefully, as it could increase your tax liability for the next year. Charitable contributions. Finally, consider making contributions to charitable organizations. Not only does this support the community and can act as advertising, but it can also provide your business with a tax deduction. As mentioned earlier, when you review your numbers, you may find that taxes are not your issue, but instead you are on track to make less money than last year or even lose money. If this is the case for you, you may want to review and reduce expenses. The first step should be to review all of your business expenses in detail to identify any areas where costs can be reduced without having an impact on the quality of your services. This could include switching to more cost-effective goods or services, reducing unnecessary overhead costs, or identifying ways to utilize resources more effectively. Improve billing and collection processes. If slow paying families are a problem, consider improving your billing and collection processes. This could help to increase cash flow and reduce the need for borrowing to recover expenses. Explore financing options. If you are facing a temporary cash flow problem, consider a short-term business loan or line of credit to help cover expenses. However, this should be approached with caution, as it could lead to additional financial obligations. Evaluate pricing strategy. If costs have risen, it might be necessary to increase prices. This requires careful consideration, however, as it could impact customer retention and sales volume. Seek professional guidance. If you continue to struggle with lower revenue and higher expenses, seek the help of a financial advisor or business consultant for support. They can provide a fresh perspective and suggest strategies for improving financial stability. Proactive planning for year-end tax savings is a crucial process for business owners. By analyzing your revenue, expenses, and estimated tax payments, you can estimate your profit and tax obligations. Also, it can give you a chance to change the direction of your business if you find that revenue, not taxes, are your biggest issue. Remember, these are broad strategies, and the best approach will depend on the specifics of your business. It's always a good idea to consult with a tax or financial professional to make sure you're making the best decisions for your business's unique situations. Visit www.cresernm.org to find our contact information, sign up for coaching, access Crecer New Mexico provider resources, ECECD recommended tools to help build your business, and more. All resources available in English and Spanish.